Okay, today is my next series in the investing industry. I just want to bring this to some people's attention. So, if you invest, whether it's stocks or bonds, usually bonds pay less because they're more secure, and then you got short reserves over here. This is from Vanguard, if you can't tell. And then obviously stocks are going to be, the rate of return is going to be a lot higher for over the years. As you can see, almost 89% for the next 40 years. The bonds have a 9.4, which is actually really good. Those rates of returns for those bonds are pretty good. The short-term reserves, I guess is all right. But those stock bonds are really high because if a company defaults, then you're out of that money. So there's a huge risk. But bonds usually are like government, and the government almost never defaults. Not saying it won't happen. And then this is the other side. So these are, this is from Vanguard. This is through the company I work for, showing me the different rates of returns for that 1, 2, 30, 40 years. So it's not horrible, but I like to throw investments at different things. So like maybe I'll throw, like if I was going to invest in a stock, maybe I'll do Amazon, FedEx, UPS. I like to tend to do airlines because they don't tend to default. Banks don't tend to default unless it's a sketchy bank, but then they'd have higher rates of returns. But all of them sell bonds, and each one will tell you the percentage of your rate of return if they don't default. So it just depends on the bank itself, and it depends on, you have to look at everything. But I don't tend to put all of my money in one stock or all stocks. I've learned that's a quick way to lose your money. Putting all your money towards stock and the stock market crashes, you're out of all his money. Just like an example right now, it's a bad time to take money out of the stock market because prices they're going down. But it's great to put money into the stock market because prices are low. Say like right now, the bonds are having higher rates of returns than stocks because stocks are plummeting down for a recession. So it just depends on the year, and it also depends on whether you keep it or you sell it short and then reinvest it, or change your investment. But I like to tend to do mixed, and then don't just be like fixated on, if I'm going to do airlines, that's all I'm going to do. Because if the whole airline market crashes, then you're out all that money too. So you gotta just pick and choose and do your research. If you don't know how to do research for these, most of the time you can find it online, but or ask an advisor. I tend not to like to ask an advisor because advisors are really expensive. And it's just like, why am I going to ask an advisor when I get the degree? I have a degree and I do this all the time. But that's why I don't throw my money at one thing, because I've seen stuff crash. You can even look at the history from the stock market. That's available on the web. Nobody can hide it, and you go from there. You can't hide the past and history, and you can see right then and there when the government defaulted, usually, and then when corporates defaulted. And what you will find is corporations default more than government, a lot more. So that's why the rates of return for government are a lot lower, because there's less chance of defaulting. But if they have a higher interest rate, like a new startup company, they're going to have a higher rate of return. So maybe that 12% up there at the top, the 13, because these will be all new companies coming out of the get-go. Or it'll be a company that needs more cash available right now. But this is obviously 65 years. So, I mean, the rate of return is not that. That's like, that's not over 30 years. That's like 0.5% a year. Which is alright. It's not great, but if somebody's going to take my money for that long, you know, I better have a good rate of return. It's not horrible. 13% is not horrible. That's per year. So, I mean, that's like what, 1% a year or percent a month. So, I mean, it's not horrible, but it's up to that time. And that's not based on this sheet, but you just kind of have to look. I'll show you in my next video what I'm talking about, but this is to switch between papers. It just requires another video. But then like here, it tells you the risk levels. So see, 2 is a low risk, 4 is high. So I mean, I have another one, 401k too, and I can show you that one. But that one's this is for a warehouse company, and they go through Vanguard, but their stocks are pretty high, but I don't know if they'll default. I mean, you never know. It just depends on how the company does, whether they acquire too much debt or acquire too much stuff, or, you know, buy too many planes that they shouldn't have, or whatever the case may be. So, alright. So, like I said, do research when you are buying stocks and bonds. Don't throw everything in one stock or bond. No matter what somebody says, you gotta look out for yourself. Because if the stock market tells you something, they're gonna tell you just to try to, you know, they're gonna try to upsell you. And then when that company defaults, because they can't tell, when they're going to default, then you lost all your money and you trusted a security advisor who you don't even know. So I do my research before I invest anything into the stock market. Because, and like I said, that's why I like low risk. I love those low risk. So I'd probably do 2, maybe 3. I'm not going to go for the 4 or 5. If I do, it's going to be very, very low. It's going to be the 10% of my investments. Why? Because when they default, I don't want to eat up that cost. So if it's $4,000, for an example, and I lost $3,000 of it because they were all high risk, that's a big chunk of an investment gone. I have to do it all over again. Or, you know, if I was planning on using that for my, you know, college or whatever, or my kids or whatever, I just lost all that for them. So it just depends on what you're trying to use it for. Invest wisely. Advisors, you know, are out there, but it's your retirement. It's not their retirement. So you gotta do your homework and make sure you have funds at retirements, because nobody wants to work till they're 80 or 90. That's always a big reference why I started early, because I don't want to work till I'm 80 or 90.